About a year ago, I was tasked with creating a portfolio for someone I adore. I love this person, like lay down my life kind of love for this person. And he had $18,000 to invest, which is a lot of money, especially for someone in their 20s. So, as you can imagine, this was kind of scary for me. It's one thing to make a mistake with money that I earned, but quite another to make decisions for someone else who's just starting out and potentially putting that money and future at risk. Did I mention I adore this person? I love him. So in this video, I'm going to share how any investor, regardless of experience, can learn a few simple concepts and start investing. And later on, I'll share his portfolio and how we did with our picks. I recently asked the hopeful investor community, when you first started your dividend investing journey, what were the biggest challenges you faced? And here's all the answers. Deciding on investment style. I didn't understand that there was no point owning 30 plus different stocks when I could just have 3 to 5 ETFs and accomplish the same thing with better results. Melissa and I are clearly on the same wavelength because I'm still fixing my buy everything mentality from early on. May have read too many books, a smidge, which they later refer to as knowledge junkie pacifiers, which is totally my new favorite phrase. Anyway, the point in sharing all this is that we're all in the same boat when we first get started. We don't know what we're doing, so we just have to start, but I want to give you a few metrics that we used when we created this portfolio because I think they might be helpful to you. Now, there are a ton of ways to review a stock or ETF, and each of you may have your very own process, but we're going to stick with the basics today. In my mind, there are 3 metrics that are a great place to start when you look at stocks to include in a dividend growth portfolio. One is free cash flow. Does the company have enough cash on hand to actually pay you a dividend? We're here on Investopedia, and we can look at the definition. Free cash flow represents the cash that a company generates after accounting for cash outflows to support operations and maintain its capital assets. So in order to simplify the concept, let's remember my canine confections company. I first shared this with you guys in the BDC video I did a little while back. But I'm able to make money selling all the delectable treats for your dogs. But there are costs associated with running this business. I've got to buy all the ingredients, pay my employees to make the treats, and I've got to pay rent on the store. So the money I have left over after I've paid for everything is kind of like my free cash flow. So if a company has a good amount of free cash flow, it means that they've got extra money to reward their shareholders with dividends. As we start to look at the holdings in the portfolio that we built, one of the first companies we selected was Microsoft. So let's look at their free cash flow. If we go into the dividend tracker, you can see right off the rip that the dividend grade assigned is a 92, which is pretty solid, right? We can see the last 12 years of data for free cash flow for Microsoft. And last year, they're sitting at $59 billion in free cash flow. So I'm pretty confident that Microsoft is going to be able to continue to pay us that dividend. In contrast, if we look at a company like Medical Properties Trust, it's not a pretty picture. And if we scroll down a wee bit further, we can see the historical dividend information. And instead of a dividend growth increase, we see a dividend decrease in the amount of 48.28% back in October of 2023. But as we saw earlier, they were clearly struggling with free cash flow. So this is definitely a metric you're going to want to keep an eye on with any of your holdings if you want to continue to be privy to the divvy. So unlike Medical Properties Trust, which has a negative growth rate, we want to find companies with positive, stable growth rates, which brings me to metric number 2, which is the dividend growth rate. If you watch the news, everyone is talking about inflation. The price of everything has gone up. Thankfully, I can still get a Costco chicken for $5, but life is costly right now. If you are investing in dividend companies, don't you want companies who continue to grow their dividends while outpacing inflation? I know I sure do. But what is the dividend growth rate? Well, we're here again on Investopedia, and the definition is the annualized percentage rate of growth of a particular stock's dividend over time. So year over year, they are continuing to grow the dividend that they pay to their shareholders. So let's go back to the Canine Confections Company. We've got the best dog treats in town. Your dogs love them, and we're killing it. So instead of paying $5 a share to our shareholders, we are going to increase the amount to $5.50 a share, which equates to a 10% increase in the dividend. To give you the math behind this is pretty simple. You take the new dividend amount of $5.50 and subtract the original amount of $5. We then divide that amount by the original amount of $5 and then multiply by 100 to get the percentage. So in this scenario, shareholders of the Canine Confections Company would be getting that 10% raise. I can't say I've ever gotten a 10% raise. How about you guys? So why is the dividend growth rate important to us when selecting companies to invest in? Well, companies that have the ability to consistently increase the amount of money they give to their shareholders are typically in good financial health and have successful businesses. So if we head on over to Seeking Alpha, you can see that they're giving you a big warning sign that they are indeed at risk of performing badly. But if we look at their dividends and then at the growth history, you can see it's pretty rough all around. But if we look at the same information for Microsoft, they have a history of growing their dividend each year, and the dividend growth rate is outpacing inflation. Now, many of you might be thinking that Microsoft isn't much of a dividend stock because the yield is so low. And you'd be right. The yield is low. The 4-year average yield is 0.9%, and the forward yield is 0.75% right now based on the current share price. But I want to introduce you to the third metric to be aware of when picking stocks and ETFs, and that is total return. Total return combines both capital appreciation or depreciation and income generated from an investment over a specific period of time. So if we come back into Seeking Alpha and go to the Chartings tab, we have some options, and the first is that we need to select total return as a metric. So we're going to select metrics, performance, total return, and then update the chart. We then have the option to sort the data by many different time frames, and we also have the option to compare it to an index, as it's shown here with the S&P 500, or we can compare to a different company altogether. And you can see in looking at all of these time frames that Microsoft has consistently outperformed the S&P 500 for total return. So how do you calculate it? The formula for calculating total return is to take the ending value, so that's what the current value is right now, subtract the beginning value, where you started from when you purchased that investment, add in any income that you've received from dividends or interest, and then divide that by the beginning value, or what you initially paid for the investment. Once you have that number, you're going to multiply it times 100 because that's going to give you the percentage for total return. Now, Microsoft is just one of 9 holdings in the portfolio that we built out a little over a year ago. And recently I asked you guys what y'all thought was the most appropriate number of holdings to have. And obviously, it's whatever you think is appropriate because it's personal finance and your investments. But the vast majority of folks that responded said between 9, not 9, they didn't say 9, they said between 10 and 15 because that was what I offered as an option. Anyway, of the 3 metrics that we just reviewed, Microsoft is a pretty solid performer, checking all the boxes for free cash flow, dividend growth rate, and total return. So what else did we add to this portfolio? Well, the list is kind of short. There's only 9 holdings. We just talked about Microsoft, but there's also shares of Arbor Realty Trust, which if you missed it, I recently did a deep dive on. I'll link to that video in the comments. Merck, I can never say Merck, you guys. Merck, I struggle. Anyway, AbbVie, SCHD, Home Depot, Procter & Gamble, Chevron, and Realty Income. And you can see here the ticker, the price, the dividend that they pay annually, the current yield, payout ratio, years of dividend growth, the 5-year dividend growth rate, and the 10-year total return. Right now, this portfolio has the DRIP turned on, or the dividend reinvestment plan. So this just means that as any dividends are paid, they're reinvested back into the holding that paid them. So in the last year, this portfolio has earned a total of $836.63 in dividend income, which I feel like is a pretty good start for a portfolio that has years to grow. We're essentially leaving this portfolio on autopilot right now, and we're going to monitor it every 6 months to make sure that the holdings are still pretty solid. Honestly, I'm not super impressed with Procter & Gamble, Chevron, or Realty Income, as the dividend growth rate isn't what I'd like it to be based on the time horizon for this younger investor. I'm actually considering swapping out Procter & Gamble for a higher dividend growth company like Costco. What do you guys think? Overall, the total gain in this portfolio is sitting at 18.12%, which I'm pretty happy about. Now, if you only had 3 metrics to use to make your stock selections, which 3 would you choose? I would love to hear what you guys think. But if you're wondering what other metrics I use that might help you to make better investing decisions, I want you to take a peek at this video next so you can learn the 11 different metrics that I use when evaluating stocks.